Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global rate specialists, Giles Gale, head of European rate strategy, Blake Gwinn, head of US rate strategy, and Theo Chapsalis, head of UK rate strategy. Hi everyone, welcome back to another week of Bondcast. We'll get straight into it this week because I feel like every week we're doing this, we have a new forecast to update on. But this week, Blake, it's your turn. You've updated your 10-year Treasury forecast to 2% for year end. So do you want to just take it away and talk us through the rationale behind that updated forecast?
Yeah, sure. I feel like it's actually been my turn quite a few times this year. So what's one more? I think when we are kind of looking at what we've already, kind of gotten this year, looking back at Q1, the low hanging fruit, the easy move has really been done. I think the really strong sell-off we had throughout Q1 was the very rapid pricing in of vaccine optimism, of fiscal stimulus post Georgia election. We're not likely to have that repeat in Q2, Q3. But I do think yields continue to grind higher. And I think that's really comes down to three main factors. One is that, we see this theme about an earlier, faster Fed hike continuing. And I think the market's going to continue to push that pricing higher and steeper sooner in time. And it doesn't really matter whether I think that that's going to be delivered or not. I personally think that the Fed's going to stick to their flexible average inflation targeting scheme. I think they are going to stick to this kind of newfound definition of full employment that is much more inclusive. I think both of those things probably put them in a much more dovish reaction function than they have been in the past. And I also think that inflation is probably not going to over deliver to the point where it's going to force them into hikes. All that being said, I don't think the market really has to care about those things. I think they're going to keep running with this theme throughout the year. There's going to be nothing to disprove on the inflation front. This kind of forward-looking theme that after the vaccine rollout and after activity kind of bounces in the second half, that we're not going to see inflation. There's really going to be nothing that challenges that theme. So I think people who question the Fed's a commitment to low rates on the basis that the Fed's being too naive about their inflation forecasts, and inflation is going to end up out delivering and pushing them into hikes. So there's not going to be anything to really disprove that theme in the next, let's call it 6 to 7 months. And then I think there's another camp that really doesn't believe the reaction function change. They think that the Fed is kind of paying lip service to this flexible average inflation targeting, that the new kind of socially inclusive mandate. That's a lip service, and that once the Fed actually sees a little bit of inflation later this year, they're going to get spooked and move very quickly into a hiking cycle as they've done in the past. So I think markets are just going to continue to not trust the Fed on that and push Fed hike pricing higher. And I think that can stay for some time, even if I personally think that the Fed is going to stay lower for a lot longer than expected. The second thing is supply. This is a theme we've been highlighting the entire year, basically back to November when we wrote our year ahead. A number I've said a lot of times, around 1.1 trillion gross per quarter, a lot of supply to take down when you consider the quarterly gross used to be around 670, 680 prior to COVID. That actually has been, I think, the last month showing some signs of getting more difficult for the markets to take down. We've had, several fairly bad auctions. We had 2 of the worst 7-year auctions we've ever had. We've had a clunky 20-year auction. And there have been several times where we've kind of had a re-auction process where, if you will, where we have an auction that goes all right, but then in the week or two after, at some point, there's kind of a repricing that goes on in the market as dealers have to eventually just get the supply off of their balance sheets. So all those are kind of signs to me that this, supply and digestion is starting to pick up a little bit. And I think that's going to continue throughout the year and continue to keep upward pressure on yields. The third thing is that, even though I think, as I mentioned up top, a lot of the low hanging fruit has been picked with regards to, optimism regarding the second half, it's largely priced in. I think as we actually see some positive data prints realized, it's going to embolden markets to kind of continue on with that reflation theme a little bit. Again, nothing like what we saw in Q1, where we went from pricing, basically nothing to pricing everything. But I do think that can continue throughout, the next 6 to 7 months as we get some positive data prints. I think markets just feel emboldened to kind of push that reflation theme a little bit further. So again, something that keeps upward pressure on yields.
Okay, so I guess you sort of implicitly mentioned it through, the recovery story and optimism, and also the supply story. But one kind of big theme I guess you didn't mention is around fiscal policy and the upside risks to that. I know we discussed it briefly last week, but surely a big fiscal package also adds kind of upside risk to those forecasts.
Yeah, for sure. And to be clear, that's something that I haven't yet worked into my forecast. When we do these kind of year ahead forecasts, it's always a modal forecast. It's my most likely path. But I do think one of the biggest risks to that path at this point is another fiscal package. I think what we've already had delivered has been essentially fully priced. The past rounds of stimulus are already evident in kind of where yields are at right now. But this Biden second round, the infrastructure package that is being discussed right now, that's something that I don't think is embedded into the price at all. I don't think markets have really taken that on yet. I think it's a combination of fiscal fatigue. We've just heard so much about fiscal stimulus through these last several rounds of spending. And I think markets are a little bit wary of that. And also, I think there's some doubt about, some pessimism about how easy this is going to be able to pass, whether it's going to make it through, what form it's going to make it through Congress in, is it going to have to be cut? And lastly, I think there's also, some thinking that this package is different than the packages before, meaning that the kind of emergency spending we saw in the prior packages was really the kind of bill where it gets signed and a week later there's checks going out to individuals, there's cash transfers to businesses, to hospitals. This is a much more slow moving package, even though the headline number is probably going to be pretty big. The starting headline number, we saw reports of 3 trillion last week, but that's something that's spread out over a number of years as the government invests in these kind of longer term projects. So it's a much more slow moving animal. I think it's probably, in my kind of modal forecast view here, is more of a 2022 story right now. I just want to see more meat around it. I want to see more details. I want to see what the plan looks like, how the politics are aligning in Congress before I really start to pencil in something large into my forecast. So right now, I really think that's still something I would classify as an upside risk to my current forecast. But if we get into the next month or two and we start seeing some very quick movement on that package, if it looks like a deal is coming together, if it looks like, some of these potential holdout Democratic senators start to fall in line more quickly than expected, that's something that's probably going to result in another upgrade to our forecast. So certainly an upside risk to yields here.
Okay, we'll watch out for that one then. And then just to bring it back to the other theme that we talked about last week too, or we've talked about it many times now on this podcast, is SLR. And we discussed last week how there could well be this gap between SLR expiring and this new, whatever this kind of new version of the SLR exemption is that the Fed brings in. Does that create any kind of upside risk around your forecast, or any risk at all to your forecast that you're thinking about?
Yeah, I think that's another upside risk that currently exists. I mean, if I had to think of kind of the two big upside risks, it's that fiscal package, and then the risk that something happens on the the SLR side ends up developing in a way that does start to weigh on treasuries. I do think the fiscal package is probably the bigger one, with SLR being kind of secondary, probably also a bit more near term. Idea here being just that essentially, as reserves continue to increase on banks' balance sheets, SLR could become a much more binding constraint now that those reserves are no longer exempted. And we talked about this last week, but I don't see. You can look through the banks' earnings statements, their calls. Nobody was really under SLR constraints, at the current time, but reserves are continuing to grow. It's going to put more pressure on those numbers, put more pressure on the balance sheets. And at the same time, the Fed's also loosening up on some controls they put on capital distributions for these banks. So you're kind of getting hit from SLR on both sides. These banks are going to start paying out capital, which lowers their capital base. And then at the same time, they're getting all these reserves onto their balance sheet, which is increasing their assets. Both of those things hit the two sides of SLR. So my concern is that at some point SLR does start to become a binding constraint for some of these banks, and that they pull back essentially on treasury buying or treasury holdings. So I certainly think that's a risk, over the next let's call it 2 or 3 months in particular, because as you said, this Fed process of finding something more long-term, a better solution, longer-term solution, is probably going to be something that takes, a couple months at least, at the very quickest. So there is that potential for some gap in there where it becomes binding and weighs on treasury demand before we actually get some kind of further guidance from the Fed.
Okay, so we've got this kind of, fairly significantly higher, I guess, year-end forecast then for 10-year with upside risks, like you say. So does that mean we maintain a very bearish view from here?
I mean, yeah, it does. And I, you mentioned those two bearish risks. I also think it's worth noting that over the last, I'd say 3 to 4 weeks, the biggest bullish risk has actually come off the table. A month ago, we were on this podcast talking about whether the Fed might push back against rising yields via WAM extension, extending the maturity of their purchases, or an operation twist or something, using their balance sheet essentially to push down on long end yields. They've come out the last 3 or 4 weeks, I think, and made it very clear that they have no interest in doing that anytime soon. So really, the biggest bullish risk is off the table. And I think, if you look at not only where our forecasts are, but these bearish risks that still exist out there, it's pretty clear where we want to be positioned. I think we're on a very short run basis, a very kind of technical basis, waiting to get involved in those positions. There's a possibility that some buying demand develops around quarter end. We have pension funds that have had a very good run in equities that might be pulling cash out of equities, putting it into bond markets, which could give a little bit of strength to bond markets over the next few weeks. And also at the same time, Japanese year ends. We've talked about this before, but treasuries look very, very attractive on a currency adjusted basis to Japanese investors, and they are crossing their year end. I had to look at my calendar to remember what day we're actually recording this, but by the time you listen to this, it might actually be across Japanese year end, and there's a possibility that we see some kind of repositioning out of Japanese accounts back into treasuries, or adding treasuries after that year end. So we just want to get past those kind of technical factors and then look at kind of resetting a more medium term, longer term shorts, and likely some form of steepeners. Although I will say, the steepeners, most of the first quarter, we were really focused on 530s. This is something that's going to be much closer in the curve. 530s, I think most of the move is done there. And I think really what we'd be looking at is something more like 2.7s, 2.10s, kind of moving that in on the curve to really take advantage of this Fed pricing story, the weakness in supply in the belly, and some of these other issues we talked about.
Okay, fair enough. That makes sense. Thanks, Blake. So I guess moving over to Europe then, which is another place where we've had, a more bullish tactical view, I'd say, very tactical kind of short-term view that sort of fits a little bit with what you were saying, Blake, about really just waiting for better entry levels to be bearish again. Giles, we said we're going to update on this view frequently, and we were pretty right last week in the bullish direction, but today we're recording this on Tuesday. Markets are selling off again. How are you feeling about that, tactical short-term bullish view right now?
Right. I mean, the very first thing I want to say is, after that very comprehensive download from Blake, I mean, I think it is important just to keep our eyes on the longer term view, which has always been, and for us, we've had this forecast for 0.25% 10-year Bund for the end of the year. That hasn't changed. And so, your question, Imogen, obviously is about, why we have just taken that off the table in the short term. Just a reminder, we did that 3 weeks ago, just after the ECB. And guess what? Bunds, in spite of the move, as we're talking on the day we record, we're selling off, but effectively we've just been in a relatively tight range pretty much all of this month. Overall, there's nothing big and new, really, I don't think, to talk about. In Europe, we are largely still following the same themes. We're talking about COVID. We're watching, I guess, the dynamics of that moving in the opposite direction to Europe and the US. Markets are reasonably concerned about that. On the other hand, the data has been pretty strong, and so the whole theme of economic resilience, I think, is still very much there, and it's we're just waiting for the opportunity to transition from this place where we're too worried about the COVID stuff, and we can focus a little bit more on the recovery and the reflation stuff, which is what is driving markets elsewhere, right? And so, is that this week? No, I don't think it is. Is it, between now and perhaps a couple of weeks from now? Yes, absolutely. I mean, one of the things that we are looking at, for example, is evidence that the supply of vaccines in Europe is actually picking up sort of along the lines of the schedules that we can see. I mean, there are plenty of charts of showing this acceleration circulating around the place. We just need some evidence that this is happening, because obviously there have been so many disappointments over the first quarter, largely related to AstraZeneca, and fortunately we're not relying fully on them for the largest part of the acceleration. But we're looking for that to change. There are some questions about COVID trends, particularly in France, which I think will take a good couple of weeks to work through, and then. Other than that, what are we saying? Well, we're probably sort of largely trading with a bit of a beta sort of sensitivity, relatively low sensitivity in the short term to global factors. But again, the theme remains that we expect that sensitivity to start to pick up. I just want to pick up very, very quickly. Sorry, Imogen. I know you want to get on to some other thing, but Blake was just talking about as he was running through his I guess the themes that he was trying to weigh up in coming to his new set of treasury forecasts. He's talking about equity bond flows, and that's something which absolutely could be there, especially in the US. I think that's overall something that I've been trying to say as a fade, as a theme. So this could be a good moment for us to look for that, and if that fails, if we don't see those equity bond flows, then maybe this idea that we're coming to a point where people are just trying to manage whatever it is, their sort of the risk parity, the 60-40, whatever, all these strategies just a little bit differently. Maybe that's actually coming good as a theme, but regardless, I think that's less relevant for Europe anyway.
Thank you, Giles. That was very expensive. There was wanted to sort of pick your brains on why, and I guess quite nicely timed with it being the end of Q1 and us now having the benefit of seeing what issuance was in Q1 and being able to start thinking about Q2 and beyond, and what the supply picture looks like in Europe. I know that's a theme that you've been doing some work on this week, so perhaps you could just give us a quick kind of high level download of how we think this year's supply is going to compare to last year, and particularly once you net off ECB purchases, what the kind of overall supply or duration that the market will have to absorb might look like, either versus last year or versus other markets too. I guess versus the US would be a good comparison.
Yeah, so this is something that people love to try to figure out. I mean, it's in some, I guess in a certain sense, the kind of most fundamental sort of analysis that you can do in bond markets. And I mean, there are times when you can be more scientific about it, and times when it's much harder, because of the uncertainties about the ECB in particular, and what it's going to be doing over the next 9 months. The uncertainties are very high at the minute. But just to give you an idea, what we have done in our latest update is we've accepted that we're probably going to see a little bit less corporate supply over the year, just because corporates are quite cash rich. Probably similar for financials. So on the credit side, probably a little bit less, but then on the government side, probably a little bit more. So we're in a similar sort of place. I mean, it's more or less tracking where we thought we were heading at the beginning of the year. I guess for me, the bottom line is that actually we think that the total availability of investment grade bonds after the euro system takes its full share, will be around about positive 175 billion euros, roughly speaking, and that I think compares with this sense, which we still get from most of our client discussions, that because of what the ECB is doing, that we're going to be in a quite squeezy sort of environment for paper. We don't see that, and that actually could be a little bit of a surprise. Nonetheless, I think it's probably more of a surprise for the second half of the year than for the next quarter. Just to give you an idea, there actually Q1 to Q2, we see the swing looking around about negative 150 billion from the investor's perspective. So that is the ECB probably buying around about 80 billion more, and overall bond sales mostly driven by a step down in credit, reducing I guess bond issuance by about 50 billion, something like that. And then so that I think feeds into our more tactical bullish view at the moment, but we're still focused on the longer term as more of a bearish theme from this.
Yeah, nice. It kind of ties in quite well then with that very short term kind of tactical bullish view, but long term still quite bearish. So the only last question I had really related to European supply was about how that fits, I guess, with our deficit forecast on a sort of country by country basis for next year. We're talking now about the lengthening of lockdown restrictions and some more kind of emergency fiscal measures that are clearly going to add to our deficit numbers. Have you taken those into account, or is there still upside risk to that baseline number that you're talking about?
The deficit projection that we have used at the EU level is just over 7%, which is higher than, I guess, the recent ECB forecasts, and I think the signals that we're getting from most of the multilateral forecasters. It's also a little bit higher than the Bloomberg consensus. Nonetheless, I would say that the risk on the deficit side is still that governments want to spend more. Nonetheless, I think that the overall message that we are getting, and I think it's pretty credible from the debt management agencies, is that they'll probably increase flexible sort of short-term funding. They also have quite high cash balances overall, so I don't think that there's a very significant risk on the bond funding side specifically from that.
Yes, Giles, that message that you've said about the higher cash balances being the message that we're getting from governments is exactly what we heard from the German finance ministry this morning, who said that on Tuesday, that is, who told us that they have this higher deficit funding needs for next year, actually only a very, very small proportion of that will be met by higher bond supply. So sticking with supply then, and moving over to you, Theo, because I think this week has been, I guess, a special week for gilts, I'll say, in that there's been zero net supply for gilts this week. So I guess, how has that played out, or how do you expect that to play out in markets, and where does that leave the outlook for the rest of April after such a low supply week this week?
Yeah, sure. I think it's actually a very good point. We have been used to receiving a lot of supply. I need to be a bit pedantic. So this was actually a negative net supply week. So gross supply was zero. So we get that, But the signal is really that we, for once in, the last time that we had something similar, it was in December, actually. So it is not that far away. But that negative supply, that lack of issuance, has got an impact for the market. And you usually see that the week before and during that week, that there is fear, there is skepticism, there is hesitation when it comes to selling the market. We've seen investors really thinking about that week and discussing it. And to be fair, I mean, we do run bearish, but we say that use any pullback to increase the bearish position, but we don't run max bearish as things stand. So where does it leave us? I guess, yeah, I mean, we stay bearish. We have been bearish. We didn't get that much of a pullback. So gilt yields at 10 years at 83 basis points. yeah, you should be bearish because we target 1%, but is this the level where you go max short? Probably no. On the issuance side and digging into the details, because this is what I think will be very interesting for the market is, in May, we will have a big syndication and we talk about a new 30-year bond coming in the market. This is going to be a new 30-year conventional bond. At the same time, we get ultra longs being supplied. So you have the big syndication at the 30-year sector, but also you get at the very back end of the curve, you get that 50-year paper also being supplied. The other point is market thoughts on the future path of net issuance. And that means that, we go to more net supply, okay, fine, in April after a quiet week, but then also going forward, the whole path is going to look for a lot more supply coming specifically from the back end of the curve. So syndications, longs, ultra longs, etc. So that's what I think. Issuance is a key part, and issuance, different to what we had in 2020. So yeah, it is also a key factor for my thoughts in the market.
Okay, and what does this mean for your curve view? If it's well known and well telegraphed that this supply will be concentrated at the back end of the curve, is that kind of price impact already priced in, or does it still lend itself to steepness in your view?
I think one key theme is that yes, it is it is well telegraphed. It is something that we know, but at the same time, the probably most discussed theme is flows out of equities into fixed income, and this is the most widely awaited theme in the UK. This is why the back end of the UK curve trades expensive. So it is interesting. We've seen on days of clearly bearish rationale and bearish signaling that the back end has failed to sell off. Now, what does it mean for the curve? I think for the curve, we are very, very careful. We do look at curve trades, but closer to specific events. From a longer point of view, from a longer term point of view, we're cautious. We don't have a curve view. We don't have a curve view deliberately, simply because while you may argue that additional supply, that indigestion will create higher back-end yields, so that's very clear. We don't know to what extent the magnitude of the purchases and the de-risking activity will just go at the back end of the curve and will support that sector. So it is easier and it is cleaner to position for a bearish view at the 10-year part of the curve, for example, than the position for a bearish view at the 30 or the 50-year part of the curve.
Okay, that all makes sense. So just finally, to wrap it up, perhaps you can give us a quick rundown of your latest inflation views, because I know, well, A, I know that's your favorite topic. I can see you smiling at that. But B,
Thanks.
Also, I know that you published a note earlier this week onto our Agile Markets portal, updating reasons of why to be bearish the 15-year part of the curve, 15-year break-evens, that is. So can you just give us a quick run through of what you're thinking there?
Yeah, I think first of all, we are in a world of weakening fixed income, and this is something that we have that in the US, we have it in the UK, we have it in Europe. In general, fixed income is cheapening up, and indeed, inflation is one of my favorite topics. In fact, UK inflation is a topic very close to my heart. Now, what do I say? To be bearish on that market? Well, I mean, UK inflation usually trades at fair value or expensive. Right now, we can see that richness, and we can see that this has happened across the curve. This has happened also very much at the back end of the curve. We've seen that the technicalities, all the index extensions that we had during March, we've seen them in the price. And that flow for cash, that coupon money that got reinvested, all that is in the price. So valuations are very, very high. Now, what does it mean? Well, clearly, one way is just to look at break-evens. The other point is also to look at real rates. So if we are in a place where inflation expectations maybe have to just calm down and get in touch with reality, a case for being bearish real rates is the obvious candidate. I think the one final point that I want to make is with the pricing of the RPI reform, and this is key. We know that from 2030 and onwards, RPI will not be the same RPI. I mean, it will still be called RPI, but what you're going to get as an investor is not going to be RPI. So you will get something which has been corrected, aligned to CPIH. Now that correcting is worth 80 basis points a year. So it is quite significant, and this is why it has caused a lot of debate. However, forwards and the curve and everything beyond the 10-year point, they just defy that RPI reform. It is as if it has never happened. And this is interesting. So the lack of pricing of the RPI reform means that this is an opportunity. And it is an opportunity both for an issuer, so for the DMO, when they look at the valuation and they look at that conventional being cheap and Link is being expensive, I think it is something very straightforward, but also for investors, because what we have seen in the past is that when there is a mispricing, it is a matter of time when this will be corrected. So this is how I think about the inflation market. And I think that, well, the months ahead of us will be particularly exciting.
Well, let's hope so. That seems like the perfect place to round off this week's episode. Thank you all for joining me, and we will catch up again next week. I hope you enjoyed this episode of Bondcast. Please do subscribe to our channel to get future episodes and like it, as this will help others to find it. We also encourage you to follow us on social media to get all our latest content. Speak to you again soon.